A trader looks at the 5-minute chart, sees a clean breakout, goes long. The trade reverses 10 minutes later and stops out. Frustrated, the trader concludes the breakout was a fake out. The setup was bad. The setup was not bad. The setup was right on the time frame being looked at. It was wrong on every time frame above. This is the most common analytical mistake in retail trading. Single time frame analysis. Trading what you see on the screen in front of you without checking what the higher time frames are doing. Markets are fractal. The same price action plays out at every time frame, but the implications are different at each level. A breakout on the 5-minute can be a counter-trend pullback on the 1 hour. A bullish daily structure can be a bearish weekly structure. A weekly support can be a monthly resistance. If your time frames disagree, the lower time frame loses. Always. Here is why. Bigger money trades bigger time frames. The institutional desk reading the daily chart is moving more capital than the retail trader reading the 5-minute. When the two time frames disagree, the institutional flow wins because it is the source of the price movement, not the result of it. The 5-minute breakout that fades is not random. It is the daily downtrend reasserting itself after a brief pullback. The 5-minute trader was reading the pullback. The daily trader was selling into it. The fix is multi-time frame alignment. Before any trade, you read 3 time frames. The strategic time frame, the one that defines the trend you are participating in. The tactical time frame, the one you take the entry on. And the execution time frame, the one you fine-tune the entry and stop on. For a swing trader, weekly is strategic, daily is tactical, 4-hour is execution. For a day trader, daily is strategic, 1 hour is tactical, 15-minute is execution. For a scalper, 1 hour is strategic, 15-minute is tactical, 3-minute is execution. The rule is simple. The strategic and tactical time frames must agree before you take the trade. If the strategic is up and the tactical is up, you are looking for longs. If the strategic is down and the tactical is down, you are looking for shorts. If they disagree, you stand aside. There is always another setup. Here is what alignment looks like in practice. Step 1. Open the strategic time frame. Mark the dominant trend direction. Higher highs and higher lows is up. Lower highs and lower lows is down. Sideways is sideways. If you cannot see a clear trend, the time frame is in transition and you should not trade. Step 2. Open the tactical time frame. Check the trend on this time frame matches the strategic. If both are up, you are in a high probability long environment. If they disagree, you wait. Step 3. Open the execution time frame. Wait for a setup that fires in the same direction as both higher time frames. Pull back to support, break of consolidation, retest of a key level. The setup itself is normal. The context that surrounds it is what makes it high probability. Common mistakes to avoid. Do not skip the strategic time frame because it is boring. It is boring because it changes slowly. That slowness is exactly what makes it valuable. The slow-moving direction is the one that pays. The fast-moving noise is what stops you out. Do not flip your time frames when a trade goes against you. The most common psychological mistake is dropping to a lower time frame to find reasons the trade can still work. The trade was wrong on the higher time frame before you took it. Dropping lower does not change that. Do not overstack time frames. 3 time frames is plenty. Reading 5 or 6 creates analysis paralysis. The strategic, the tactical, and the execution are the 3 you need. The principle behind all of this: lower time frames are noise inside higher time frame trends. Higher time frames set the context, lower time frames time the entry. If you reverse this, if you let the lower time frame drive the decision and use the higher time frame as confirmation only when convenient, you will be on the wrong side of every fake out the market produces. Trade the higher time frame, time the lower one. Let the 2 agree before you click. When they disagree, do nothing. The traders who survive long-term spend more time deciding not to trade than they spend trading. Multi-time frame alignment is the filter that produces that discipline. 3 charts, 3 time frames, 3 confirmations. Then the click.